and welcome to the Financial Thought Exchange podcast, where you learn from the leading thinkers in finance. I am your host, Lotta Moberg, and I am here for my second conversation with James Grant. You know him as the founder and editor of Grant's Interest Rate Observer. He's a deep thinker and commenter on markets and economics and authored numerous of books, among them Money of the Mind, which is a history of borrowing and lending in America, as well as The Forgotten Depression, which is what transpired in 1921. So we definitely recommend you checking out his books. There are more of them if you go on Amazon and anywhere else that you find books. He also writes biographies and has written, for example, about John Adams and Walter Bagehot. So thank you so much for sitting down here for our second conversation, Jim.
You're welcome, Lotta.
And wanted to jump right into the current situation, but really a situation that we've been dealing with for decades now, which is the U.S. debt situation, what that might mean for interest rates, bonds, and all the good things. And really want to just start by asking you where you see the U.S. is now in its fiscal situation. Should the U.S. government just default?
Well, interestingly, that thought has occurred to certain people high up in the administration. The current chairman of the Council of Economic Advisors had a well-publicized paper called the Mar-a-Lago Accord. It's like a send-up of the Plaza Accord. So the idea came to many in President Trump's inner circle that in this most transactional of administrations, what we ought to do, said they, what we ought to do is to go to the our overseas creditors and say, we protect you. Our military and naval power protects you, you ingrates. And here you are charging us interest. It's we're not going to put up with it anymore. And how you could easily imagine them saying this, right? I can imagine, in fact, I can imagine a tweet on Truth Social just to that effect. And but we're going to give you a way to make things right. We're going to give you so in lieu of the 4 3/8 of 2056, we're going to give you the opportunity to accept a security maturing in 100 years that will pay you 2%. And there might be an option to pay it in cash or in kind, or there might be an option for us to simply to pay nothing if the mood strikes us, if the need. And that 100-year security will basically never mind interest. The real gain for you in this 100-year security is that we will continue to do what we have done faithfully, which is to keep the nuclear umbrella and the Seventh Fleet, the Sixth Fleet, the Fifth Fleet available to keep the world in order. We'll do that, but we must have, by way of recompense, we must have an adjustment of the structure of the debt and the cost of the debt. And so I find. We had a piece in Grant's 2 weeks ago, and the headline over which was "Once Said Can't Be Unsaid." And so it's my conviction that once this idea is expressed, which it was in the aforementioned paper, and in everything that the administration has said, and not everything, but it's the spirit of the administration is one of transactional and rather amoral conduct of diplomatic relations. I guess famously there is no morality in diplomacy, only national interest, but we seem to be carrying that to a degree, rather to an extent, to a very high degree. So I think that there is everything to think about, and perhaps much to fear in the risk that the United States will, for very short-sighted reasons, decide to readjust unilaterally the terms and conditions of the debt contracts into which it has entered with its foreign creditors. Or to put another way, what sacrifices would you guess that the Trump administration would make to satisfy the claims of foreign creditors over the clamoring insistence for relief by American citizens, budgetary relief? So
Right.
the interest bill is now handily above the Defense Department bill and spending, and uh, if you only project somewhat conservative projections of the Congressional Budget Office and Committee for Responsible Federal Budget, and apply to those projections the assumed rate of interest of 4.3%, which is now the blended cost of federal borrowing. The interest bill becomes quite formidable very soon. And so, what are we going to do about that? Are we going to pull back on spending? Nope, we're not going to do that. And notice that the Republican tax bill now making its way into I gather the House of Representatives next as it's making its way without too much political opposition. Um, this bill is not going to satisfy anyone who is looking for substantial relief in the so-called entitlement portion. That's so-called entitlement portion, the sacred cow portion of the federal budget, which is like 75% of the whole. So there's going to be no substantive Medicaid reform, no substantive change in the terms of Social Security eligibility, heaven forfend. And to read the critiques, I gather uh, the well-sourced critiques of the work of the so-called Doge Commission, there has been no significant reduction in costs. There have been some highly publicized and theatrically successful ones, but nothing that would make a difference in the uh, the very frightening budgetary discipline, budgetary mathematics. I said so. Compound interest is a delightful thing that's working for you, but a most formidable enemy was eating you up alive. And compound interest is we are being chased now by compound interest rather than by as a society rather than by earning it. And
So the compound, I mean, I would think that inflation is in a way the compound interest that people don't realize that is being imposed on them over time too. So there's two kinds of defaults. I'm thinking default of everyone who holds anything denominated in dollars versus those that hold explicitly these contracts to which you refer in terms of like where you can lengthen maturities, change the covenants, change the rules of them, and therefore default de facto. And it feels like it should be, but it's probably not, or probably both gonna happen at the same time, but that there could be a trade-off between them and saying, should there be a default on everyone, which would be just double the monetary supply, increase the inflation, versus the ones that sign some kind of paper saying, I am lending to you, where I would be more sympathetic to the latter, but there's a lot of nooks and crannies that I might not be considering.
do deals with certain favorite creditors. You sign here.
Mhm.
Uh, there's just like he's negotiating. The president's negotiating tariffs now. The United States has defaulted 3 times. 1811, when the Treasury couldn't pay interest, this is just after the first Bank of the United States, the first national central bank, was disbanded, and so the Treasury defaulted. And then again, fast forward to 1933, when President Roosevelt uh, called in everyone's gold and announced to the world that we would no longer exchange dollar bills for $20.67 an ounce worth of gold, but rather the number would be 35. And then fast forward to 1971, and President Nixon said, "We are not going to exchange our dollar bills for anyone's, and they're not going to exchange our gold for anyone's dollar bills. Um, we have decided that we're not going to let the international speculators um, derange our domestic finances." And each one of these defaults two things about them. One is the United States survived each of them, and the second thing is that there was force majeure for perhaps for all. I was less so in 1971, um, but there was a plausible ground for suspending interest payments. I suppose in 1811, such was the absolutely busted state of American um, public finance, and the State Department could not pay its stationary bills, if you please. But what's the pretext now? It's the pretext. It's one of convenience, right? It's inconvenient for us to pay on terms that we negotiated before the sale of securities. Inconvenient. There's no, but this is the same administration that declared a state of emergency because the international trade deficit was in deficit as it has been for every year. Look at the past 40 years. Suddenly it's an emergency. So I could easily imagine it being suddenly an emergency in a year or two or three or 10 from now that an emergency that a certain large creditor demands payment of its interest when in fact it ought to be content with enjoying the privilege of selling its exports to this country. It's easily, I mean, who would rule that out? If you could make book on that, who would absolutely rule it out? So that's why, Lotta, it seems to me that if you look on Bloomberg and if you go to look at the credit default swaps in the world, sovereign credit default swaps, you'll see, perhaps to your amazement, it certainly surprised me to see that America is paying to insure the United States against default. You're paying 50 basis points a year. That's the contract is denominated in euros.
Mm.
Um, I'm not sure how much volume there is, how truly indicative it is of the worldwide sounding of sentiment. But it's a little surprising that this country is well, and it's not so surprising given that in 2011, when S&P downgraded America, the CDS, the credit default swap rate, was close to 60 basis points, and now it's 50 or so, 52. Grant's Interest Rate Observer, my pride and joy, we have been on the case for 40 years. We've been in business for 42 years. We've been on the so in our second year in business, like in 1985, we produced a mock prospectus for the Treasury as if the Treasury were a corporate borrower. And we enumerated risk factors as you would for a normal corporate credit. And we did pro forma financials. We did the whole thing as if it were a risk prospectus because I thought um, that the credit considerations ought to enter into the calculation of a fair rate of return on Treasury yields. And I'm only going to say a lot of it. Being 40 years early isn't early. That's called RONG, wrong. that that was not the right thing to worry about in 1985. But but you know what? These things do sneak up on you. These things that can't happen, and then do happen. And we talked about something. I wish I thought of this, but I'm going to bring it up again. In our first very scintillating talk, at least scintillating on your end, we were talking about inflation being the determinant of treasury of bond yields, and that will do as well as anything. We both agreed. But I was reminded um, uh, of what to me is the most interesting episode in bond yields in my time around markets, which is a long time. And that is the situation in play in the spring of 1984. So Treasury yields had peaked at 15% in 1981, and that was the end of a 35-year bond bear market. 15%. This is after inflation had rolled over, commodity prices had rolled over. So 14% was a retest, as they say in the trading pits, retest of those highs. And will you care to guess what the rate of interest, rate of return, the rate of inflation as measured in the spring of 1984 was to support a 14% yield on long-dated treasuries. What was the CPI doing?
I would guess that if it's very high, but that's the naive guess, that it's commensurable to 14%.
It was less than 5%, memory serves.
Mhm.
9 percentage points of real yield. 9 percentage points. But why didn't people? So people ran to get that, right? Nope. And they didn't because what they remembered was the preceding decades-long, not ordeal, because we don't have ordeals in finance. We want to leave that for cholera and for warfare. But the unpleasant experience of 35 years of persistently rising rates of interest that, of course, didn't heighten one's um, expected rate of return on equity. It was trouble, right? It was nagging. It was not helpful. So so they were looking backwards, not forwards, contrary to theory. Market was not forward looking, then it was looking backwards at what had been a generation length, a more than career length on Wall Street, more than career length bout of rising rates. Okay, so the application of that today would be that um, people, Americans especially, but I dare say the world, has treated the securities of the issuer of the world's reserve currency as a special species of issuer and of securities, right? Because, you know, what is next in line to be the reserve currency? You will hear it said. Nothing. Nobody. There's no successor. The dollar is it. It's Tina. It's the one and only. Is that the Tina? There's no choice, right? Tina. That's the acronym.
There is no alternative.
No, right. Um, but I don't know. But now you have
Yeah.
so I'm asking this more than affirming something. Although I guess I secretly am affirming that there's trouble coming. Not so secretly. We write about it in grass. But
It certainly gets to the point that there's no, like, part of why we like the dollar, and the treasuries that come with it is that we like our models with a risk-free rate in it, when in reality there is really no such thing as a risk-free rate, I would surmise.
it troubles the models to fouls them, and without the certitude of there being a risk-free rate, every valuation model is kind of off kilter. No, if the 10-year yield is not the North Star of finance, what is? So I think, Lotta, that a lot of this disarray in finance, um, the disorganization, the trouble, the fundamental trouble in finance is ascribable to our now decades long experiment with unsecured fiat money. There being no discipline on the issuance of treasury securities, and there being no real discipline on the expansion of the central bank's balance sheet. There's an interesting feature of the Fed's balance sheet, and that is that it is presented to the world as if it were in compliance with some accounting regime. They give if you ever looked at the H-4-1 forms out every week, it gives assets, liabilities, and
Mhm.
oh, um, except what it shows is that the cumulative loss of the Fed, because it had been buying securities yielding 2 and 3% and had been paying on its liabilities something like 5%. It shows horrific accumulating operating losses, and those are in the hundreds of billions of dollars now. So there had been like a $43 billion worth of capital in surplus now wiped out. And in lieu of that capital, there was a line item in the Fed's balance sheet that says that this is a running tab on the Treasury. The Treasury will make this good. It's kind of a contra asset or something, some phony thing. So the Fed has its own DIY accounting by which it smooths over its own deeply negative net worth. So the Fed is hypothetically, theoretically broke, as we say at grants, hypothetically, theoretically.
Mhm.
The Treasury is out over its skis. We run deficits of 6% a year in times of very low unemployment, times of great flourishing, as they like to say. Certainly the financial asset world is flourishing. And all this is happening in plain sight. And people say, well, yep, that's the privilege, the exorbitant privilege of the reserve currency country. That's nothing to be priced into anything. That's just the way it is. That's Tina. There's no alternative. And I have made my living in saying, no, it is trouble. There is an alternative. And don't think for 1 minute this is meant to last. Now, um, um, it's true, Tina, true, there have been different monetary regimes, but all of this works in geological time, right? They don't change in the ordinary course of a career or even a man's lifetime. So I'm afraid I have rather built for myself the reputation of a monetary calamity howler. But what I have seen is the accumulation of, moral hazard, of willful ignorance about the state of the Fed's own finances, and about the sloughing off of concern over the state of the Treasury's finances by a world that would not prefer to have to think about them, and by a country that is privileged not to have to think about them. And so on form, which we've had risks. The risks have been snowballing. And I can cite, if we had 2 or 3 hours, I could cite you chapter and verse almost by the fiscal core going back decades about people who raised their hands and said, this really isn't working. All this paper money, all of this borrowing. They were worried about in 1958. They conferred, Senate convened um, hearings on the trouble with the Treasury's credit about inflation. Inflation that was running about 3%, and people were going, do you have any idea where this is leading? And that was what it led to was years of great complacency because inflation rates subsided. And it was very small, very, very low into the early 60s. And then anyway, so um, I'm not going to, despite this threat, I'm not going to do that recitation. But the great question to me now is this the time that is this the time that it crystallizes into something actionable? And that is that's the business model problem for grants, right? Because just say hypothetically, you're a 79-year-old, approximately, gentleman who has, let us say, cried wolf now and again about this problem, is now rather front and center. Do you press hard and say, no, no, it's over? Or do you take the measured approach and say, well, it's fine for now. I'll let you know when. But of course, nobody will know when, right? Someday somebody's going to forget to bid on the treasuries, or someday um, uh, someone in Beijing might think that, well, Donald Trump has revealed himself in these tariff negotiations to be rather a paper tiger, and that really, if he wanted to move on Taiwan, this might be just the moment, because we know what he's going to say. He's going to huff and puff and do nothing, and we will have our prize. We'll do a blockade just to test them, and then we'll grab Taiwan, and we'll show the world that the renminbi actually is the next currency. Where do you suppose treasuries would open the next morning? See, so you can't know, right? You can't know. So I guess the investment lesson um, is diversification, right? It's to not to be locked into some historically ignorant fixation on what has happened for the past 35, 40, 50, even 100 years. You have to. I think the CFA Institute has something to say about diversification. It's in favor of it, right? CFAs, yeah, I think in favor. So like,
Yes. So just to try to step back to the fiscal situation here. And by the way, the when it comes to you mentioned the central bank running a deficit, I would really recommend Bill Nelson having great writings on this. Really looking closely at this. There's I wanted to ask you about when it comes to the fiscal part of kind of monetary policy here and how they're intertwined. There's quite some talk now about fiscal dominance and that kind of coming into play in more front and center people's mind because of the developments that we're seeing now and people getting worried about the a trade war and selling off of treasuries and the implications. How would you frame that in your mind? Like what is what does fiscal dominance mean maybe and play a part in the kind of scenarios that you're imagining where we are coming to a situation here where the treasuries are not no longer seen as the risk-free assets.
Fiscal dominance means nothing more, I guess, than the needs of the Treasury determining the course of monetary policy.
Mhm.
But as for the independence of the Fed from the Treasury, it's a myth. No, if the Fed is into the Treasury for whatever it is, I forget number $200 billion called. That's the tab it's running on the Treasury for its operating losses. Does that describe an independent body to you? That's and the Fed is a is as dependent an agency as you can imagine, dependent that is on the Treasury. So I think that fiscal dominance is effectively here. I think the strong form of fiscal dominance is uh, the Fed doesn't even bother to monetize the debt, but simply writes checks to the Treasury to finance. But there have been subtle instances of fiscal dominance. I think 1973 was the year of a failed auction of 20-year notes, 20-year bonds, rather, 20-year bonds. Um, this goes back a ways, of course, but um, if 73 was the year, the summertime, I remember the Treasury had a small issue, I don't know, a few $100 million of this 100-year bond, and nobody came. Not enough people came. They failed. The auction failed. It was rather a shock. This was a time of the Arab oil embargo and of rising inflation concerns and concerns, fears, or realization of that inflation was a real problem. And so, what to do if you're the Fed? Well, the next day there was an auction. They got kind of a do over the next day, and lo and behold, the auction was blew, as they say in the bond world. The securities flew out the window. It was a great success. And the financial press wrote about it in this knowing way of the financial press, people that don't want to compromise their sources or get the Fed mad at them. They said, "Oh, you almost," in so many words, you'd almost believe the Fed itself was helping. Yeah. So the Fed was there, led a hand, but that was a surprise because you'd kind of freak out if the Fed were monetizing debt at a time of rising inflation. Okay, let's just go forward 50 years or more. And I guess 52 years. And now, how would the Fed rescue a failed auction with everyone looking at the not quite completed job of vanquishing inflation? And what would President Trump say if nobody came to, if not enough people came and auction were underbid and want and tailed in a menacing, frightening way, and the treasury market sold off, and the mortgage market sold off, and the stock market sold off. No matter what Scott Besson said, it wouldn't help. What we do. So again, I think you have to. I think what is wanted now is just a deeper historical understanding of the way things have and can go wrong with sovereign debt and with the institution of paper money. Institution of paper money has come and gone in this country. It was episodes of a nominal gold standard, but actually a paper standard and practice. And the whole monetary history of America is a rather checkered thing. Um, and while it is perfectly natural that people have to live in the world in the here and now and don't have the time to delve into Scylla and Homer's history of interest rates, first 3,000 years, um, I think what everyone owes it to himself or herself if he or she is is in a fiduciary position, not to be complacent about the position of the Treasury and the Fed in these days of demonstrable vulnerability.
And it sounds like what you're with the examples that you make, that the surprise in rates, what should people then expect if I think, oh well, this is a different regime? You really don't shouldn't think of the central bank as independent, if it ever was. Um, is higher interest rates because of this, the monetization of debt, meaning just stepping in and buying outright, if anything, should suggest higher inflation, therefore high interest rates. Because I can see that there could be an argument on the other direction that fiscal dominance means even though the government is spending so much and therefore rates should go up, the central bank is being pushed by the government to lower interest rate to contravene the expenses that comes with the borrowing that implies. And so I feel like it could go different ways depending on how you think about the dynamics.
Yes, it could. Um, in response to a hiccup in the Treasury auction schedule and a sell-off to Treasury bonds, uh, the Liz Truss moment, so to speak, that people keep on talking about. It could be the shocks the Congress and then the executive branch of government here in America into action, constructive action. And it might be in the aftermath of something like that uh, that America pulls up its socks and decides that the world does not owe it a living, and that it humbly puts its house in order again. That is one possibility. I don't see humility being the strong suit of the present regime here in America. That's one possibility. America's got 9 lives, or at least 10 lives, and I'm very proud of my country for having that many lives. So it could work out. So many things that you didn't think would have worked out have worked out, right? President Nixon announces the dollar is going to be no more exchangeable into gold at a fixed price. He's reneging. He is cheating on this contract. The French are speechless with rage. They're incandescent. Um, the world is angry. The dollar is a piece of paper of no mean. Oh, what's this in the 70s? And look what happened. Um, America went on, and the inflationary crisis passed. Thank you, Paul A. Volcker and others. And what followed was the greatest uh, bull market of financial assets anyone could ever imagine. Right, like 1981 to 2021. It's beyond inconceivable how okay, that's one possibility. The other possibility is we are on the edge of a new monetary regime. What would that mean? Well, notice who's been buying the gold recently. It has been, in good part, central banks. Now, why would a central bank, which is a dealer in fiat currency, why would a central bank buy gold bullion, this sterile asset of yesteryear? And think of the opportunity cost. If you're in there buying significant amounts of gold, you are foregoing the interest on, say, a 10-year treasury of 4 5/8 or 4.5% almost. That's a lot of interest income foregone. So that choice is of a piece with the CDS being 52 basis points, right? That's an expression of anxiety about the public credit of the United States, the public credit, the old phrase from Alexander Hamilton's time. So it could be that the central bank gold bond could be the run of the gold price in the past year from 2,200 to 3,200 is the cutting edge of a new monetary regime to the astonishment of everyone in academic economics. Now I'm talking my book because I am such a gold. I am a double invertebrate, like I confess to you. I am a bookworm and a gold bug. And um, so, what a confounding thing it would be if the world were to elide into a gold standard of some kind. The original gold standard was very rigorous and perhaps unsuited to the present day. But the People's Republic has been buying gold. And what would happen, never mind Taiwan for a second, what would happen if Xi Jinping said, we intend to present to the world a renminbi that is not at all like anything in the world today. It is a gold renminbi. And you've seen the public credit of the United States. You just look at the figures. Aren't they shocking? We have an alternative for you, even as we have an alternative for you in the ports we can build for you and the lovely ideology that we have for you. Oh, never mind that. But we have our way, and that the gold renminbi is ours to give to the world, and we have the will and the way to make it work. What would Mr. Besant say? They want the dollar lower. Well, that might make it lower. So so that would delight me as a proprietor of grants. And if once you get locked into a position, I dare say, getting 40 odd years of saying much the same thing with respect to monetary affairs, you get locked into a position. The temptation is to become um, as blinded by historical precedent and your own interests and your own record of of commentary. About blinded by that as some are by other things. So what I try to do is to remain open-minded about how things could do. You said it so well a few minutes ago. Yeah, you can have many different outcomes, right? You can have a good outcome, you have a middling one, a muddling through. Journalists never ascribe the weight to a muddling through outcomes they ought to. It is not dramatic, and what sells subscriptions is drama, right? Muddling through is not nearly so helpful in building a journalistic brand. But
Yeah, no, it's thank you so much because eh, it's still the muddling through is often the default answer because it is most of the time the most likely answer, at least for the shorter term outlook. And now this has been a great reminder that when we look back in history and your a wealth of knowledge in this, there have been big changes and there will be more big changes. We don't know exactly which, but we can use deductive logic and speculate and therefore think about how to stay vigilant. So thank you for those words. I don't know if anything you want to say in closing before we wrap up here.
well, I want to
Summarize.
my gratitude for you to remember our meeting so long ago, and for you to have me on this terrific program. And it's been a delight, Lotta. Thank you.
Thank you. It's been so great to hear you. We're so privileged to have you here. And thank you, everyone, for tuning in to the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. We have had two conversations. So if you missed the first one with Jim Grant, check it out. They're both published when you see this. He is the editor of Grant Interest Rate Observer. I would be remiss to mention that you also have a podcast to check out, Grant's Rate Interest Rate Observer of the Air. It's a great one as well, so you can hear more of his voice. Thank you so much, and talk to you next time.
I like that. Thank you, Lotta. Bye.
For more information, please visit rpc.cfainstitute.org/research-foundation.